Hello everyone, welcome to another video. In this video, I'm going to share the 5 financial concepts that improved my financial IQ and helped me build this 3 crores plus portfolio. So these are financial concepts that I started learning on my journey over the past 6 years. I've been investing. Over the past 12 years, I've been running a business. Before I was freelancing, then I moved to start an agency. And these principles have really helped me stay consistent on this journey, multiply my income, grow my wealth, and then invest in a way that it continues to preserve and grow my investments. So these are those financial concepts. Let's start. The first one is compounding. And I think this is the key principle. And once I understood this, not only did I stop trading, I was doing a little bit of swing trading in the past and I was getting good results. But once I learned compounding, I realized how important it is to have longer term investments. So now I only look at investments that I can pass on to the next generations, and all my investment strategy is structured around index investing. So compounding over a long period of time is really the eighth wonder of the world. So this is how my portfolio has grown over the past few years, but compounding really shines when the time period extends. So there are 3 factors that you can consider into a compounding calculation. The first one is, of course, how much amount can you consistently invest? That's going to be multiplied by how long can you stay invested? And that's going to be multiplied by the return rate on an average that you get on an annual basis. And for me, the first 2 factors are extremely important. When it comes to the third factor, which is the return rate, I just want to target the market returns. So I don't try to beat the market, and I just want to invest in the market and get the market returns, because I know that on my side, I have the first 2 factors which are going to play really well, because I know how to increase my income. I know how to make more money by creating more value for others. And I also understand that I can stay invested for a long period of time because I don't sell my investments, right? So I really care about those 2 factors much more than trying to optimize for that extra 1 or 2%, which I know for a lot of people may be beneficial, but it's just that I'm trying to optimize on the first 2 factors, right? So important thing to remember here is that money makes money, and the money that makes money makes more money. So the power of compounding is also that the money that you're making from the market is going back and making more money. And essentially how I think about this is that I'm creating value for the businesses that I'm investing in. So just by investing in the Nifty 50, for example, I'm investing in the top 50 companies in India. As India grows as an economy, these companies will also grow. They can use my investments, and when the company grows, I get more money back and then get back to my compounding loop. And this is how the wealth is scaled. And this is why most of the money is made at the end of the curve. So if you're investing for 20 years, most of your money is going to be made in the last 2 years. But if you increase your investing by 25 years, you'll make much more than you made in those 20 years. So you'll multiply a lot more. If you do it for 30 years, 35 years, so forth, it's just going to go crazy. And I've put up a calculator in one of my other videos, which you can check out. Also, we'll put a link of that calculator in this video description, where you can run these numbers yourself to experience the power of compounding, right? Okay, so the important concept to understand here, which is why I moved away from trading, is that with trading, you sell, you pay taxes, and you lose compounding. But with long-term investing, you make money not just on the amount that you invested, but also on the returns when you keep it for a long period of time. The second financial concept is Rupee Cost Averaging. And this curve shows this really well. And I picked this up from usbank.com. If you're investing, let's say, the same amount on different time periods. So let's say you invest the same amount in Jan, maybe the market is low and you're able to buy higher number of units with that same amount. So let's say every unit costs 1,000 rupees, you invest 10,000 rupees, you buy 10 units. But if you still invest 10,000 rupees in March, the market is going up, maybe you buy a lesser number of units. In June, let's say the price has increased a lot, you still invest, you maybe buy it at an expensive price, so you get lower number of shares or units. And then let's say the market crashes, you're consistently just investing the same amount. Now you're getting a discount on your purchase. So it makes a lot of sense, instead of trying to time the market, because no one really knows actually what's going to happen to the market. If you have a systematic plan where you keep investing the amount consistently in the market, you'll end up with the average buying cost of the market, right? And this is something that we call the SIP, right? So look at this. This is the Nifty 50 for the last 5 years. If you are investing consistently, you may be investing here, and you may feel that, oh, the market is going up, should I invest or not? But you keep investing. So keep buying it at a premium price. And then the market crashes and you're thinking, oh, should I buy or not? But you keep buying. Now you're buying it at a discount. Then the market is going up. You're saying, should I buy it or not? But you keep buying. So you're buying it at a premium. Then the market takes a dip. You still buy. It goes up. You still buy. It goes down. You still buy. Eventually, over a long period of time, those small dips will disappear and you'll see the graph basically just going up, right? And I'm talking only about the India market in this video, but the idea is that most markets will follow this kind of a curve. Now, there's exceptions where for a long period of time, for example, Japan's curve did not consistently go up. There are always exceptions. But in most cases, you'll see if you can bet on the economy of that country, then the market over a long period of time will go up. Of course, in the short period of time, it looks like, oh, should I buy now because it's like 24,700? Or should I buy? And people were thinking the same thing when it was 18,000. People were thinking the same thing when it was 14,000. So instead of thinking you want to automate this, you don't have to think about it. You don't have to worry about it, knowing that your country is going to grow as an economy. So a great tool to automate this entire Rupee cost averaging process is the SIP. I use it to some extent. As you can see, I'm majorly investing in the index. So I have, invested 30 lakhs. Presently, it's around 44.5 lakhs in the mid-cap 150 index, 43 present value of Next 50 and 38 of Nifty 50. So that's the top 250 companies of India that I'm betting on. And this has crossed a crore of investment, right? But I've been consistently investing this as lump sum. And then we have some mutual funds that I have as well for mid-cap and small cap where I do an SIP. So the more you can discipline yourself or automate the approach, the more Rupee cost averaging you'll be able to leverage. And that's at least my philosophy to investing, right? The third concept is net worth tracking. And this has been a game changer for me because not only have I seen the power of power of compounding, but I've also been on a month-on-month basis been able to track how my assets are looking like, what all kinds of asset classes am I investing in, and what are my liabilities, and then look at how my net worth is growing. So I started net worth tracking in 2017, which was a bit after I started investing. So the first business that I started was freelancing in 2012. Then I started the agency, incorporated the company in Bangalore in 2014. 2014 to 2016, I was just tracking my business P&L separately, not my personal net worth because I didn't have a lot. 2016 is when I consistently started doing an SIP. And 2017 is actually when I made my first net worth tracker. And the good news is you can actually get access to my net worth tracker template, not my net worth tracker, but you can put in your numbers. I've made a template for anyone who wants to use this net worth tracker. I've kept it very simple. I have seen some net worth tracker templates that have been there online, but I've made my own version because it's just much simpler for me rather than having too many columns and drop downs, etc. But you can add your own on top of it. So I'll leave a link in the video as well if you want this net worth tracker, but this is exactly the one that I use. So the first tab is a dashboard which compares my net worth at different time periods. And for each month, I have a tab that looks like this, right? So you're going to see the assets. What are the accounts I'm using? So let's say this is a savings account. This is a sovereign gold bond. This is some P2P lending, some equity, some real estate. And then the percentage of the total assets allocated to that, which allows me to generate this graph, right? And this graph will just give me a quick highlight on the current asset classes split. And then I have the liabilities if I've taken any loans. I don't really take loans. Until now, I have not taken loans. But yes, if there is something that is a liability, maybe I have to pay someone and I haven't paid yet, which rarely happens. But if that's happening, that's going to go in the liabilities. So it could happen in a way that, for example, a business says, you'll have to pay us this much, but you'll have to pay it after 6 months. So I can't even pay them now. So I'll just put it in the liabilities because I know I'll have to pay after 6 months. So anything like that goes into liabilities. Or sometimes if you take a loan as an arbitrage, as a leverage, then that could go into liabilities. So anything that you have in liabilities can go there. And the assets minus liabilities will tell you your net worth. This is your personal net worth. This is how rich you are at any given point of time, right? So richness is always going to be assets minus liabilities and not your assets, which is a very important difference to understand. So you'll be rich in the terms of how much money you get to keep at the end and not how much money or assets you've generated, right? So And this split really gives me a clear picture. So I do this month on month, and then eventually I have a dashboard which tracks it month on month and creates a graph of how it's going month on month, right? So of course there could be occasional months when it's going down from month on month if the market is crashing or something, because I have a lot in equity. But yeah, that's doesn't affect me so much with diversification, which is the third point. So diversification and asset classes, because the first thing I started doing was SIP and equity investing, but slowly I've diversified my asset classes, and these are all the asset classes that I own right now. So I have equities, index funds, ETFs is my biggest equity game. Then I have mutual funds. SIP is mostly for small cap and mid cap. I don't do any mutual funds for large cap, which is something which I've explained in other videos as well. With index funds, it's mostly Nifty 50, Next 50, mid cap 150, and NASDAQ 100. Those are the 4 index funds where most of my investment is. Then with mutual funds, it's small cap and mid cap. Those are the 2 kinds of actively managed mutual funds I have. I have recently added momentum ETFs to my portfolio. And then finally, I have direct stock investments, which I had invested long periods of time before. So there are 9 companies that I invested in, but I don't invest in individual stocks anymore since I've become a father. Real estate, I have some residential properties that I own that I put on Airbnbs, and then other properties that I don't own, but I manage the Airbnb for them. So it's a combination of both. My real estate investments are mainly for cash flow from Airbnb, right? And they're not in India. So that's another thing that's important to understand. The third one is fixed deposits. So I typically just have some app-based fixed deposits. These are very small percentage of my portfolio, to be very honest. Then I have gold in the form of sovereign gold bonds, and I also have the gold ETF and the silver ETF. This is a little bit of a hedge. I'm not very bullish on gold, but I do have a small percentage. Given we are in India, it makes sense. Cash, emergency fund. Then I have a liquid fund. So liquid funds can be bought directly from Coin or any other app that you use. This is just for market opportunities. I can sell them anytime, no exit load. And if there is some crazy thing happening in the market, I can just put in more money in the index. That's typically the reason why this is for. And then I have business investment. So I hold a Singapore company, that's the holding company, which can maintain international currency, and I maintain a bucket of currencies. So Singapore allows you to do that. I have USD, I have pounds, I have all kinds of currencies, euros, all together in different buckets. And mostly I run an agency and an academy. So those are the business investments that I make, my own businesses, right? So far I have not invested in other people's businesses. Multiple income streams, that's the fourth concept. And this is really an important concept because I learned this when I was running multiple Airbnbs and there was the COVID crash, right? So you really need to diversify on the income streams. So of course, currently Airbnb is not my biggest income stream, but that could be number 5 on this list. But the top 4 are marketing consulting, marketing services, marketing courses. I sell courses on growth marketing, but as of now, I've kept them. I've actually made my 30 days growth marketing course completely free. And then I have commissions from partners. So I work with a lot of clients and we have a lot of tools and partners. So tools that we personally use that we found good for clients, we'll have a new client and we can tell them, you can also use this tool. Here's a referral link, and then make some commissions on that. So sometimes it's crazy. Sometimes it could go up to $10,000 a month even. This will be mostly passive now since we have invested the initial time and energy. But overall, these are my income streams in no particular order. So every month it keeps changing. Of course, if you look at when I started till now, marketing services has been my number 1 income stream, right? Finally, the 5th one is really a mindset concept. So money as a measure of value created. So whatever net worth I have right now, I think of it as a fraction of the value I've created for others, right? So when I consult businesses on marketing, I think of it this way. If I can generate $10 million of revenue for them, I might get paid $1 million, right? So I want to give 10x the value. And this also means that the money that I've made, I've also been able to create value for others, right? So I cannot make $10 million in revenue for a business just single-handedly. I'll have to hire people. I'll have to hire other marketeers. I'll have to hire performance marketeers, conversion rate optimization experts, retention marketeers, full funnel, other growth marketeers. And that's the value I've given to those people. Because even if I make $1 million, I'll probably be distributing $500,000 to everyone else, right? So money, whether it's input or output, so whether it's the income or the expenses, is all value that you created. And this is why I think of money as a flow, money as energy. When you take money, you let money go as well, right? You don't think about small things. You don't think about platform fees and tools that you pay for. I pay for many premium tools. So I have huge expenses on my accounting sheet, which is just digital tools, but they help me grow the business. They help me deliver value to clients. And when I deliver value to clients, client will pay me for that value. So just thinking of it as energy and letting it flow in the right places, of course, has really helped me. So that's the fifth and the last concept that I've used. So these are the 5 concepts. I think they are fundamentally now ingrained in my brain. I've hardwired them into my brain, and they will continue to work for me. And what you learn and what you have in your brain is something that people cannot take away from you, right? So you might lose money, you might have a market crash, your portfolio might suddenly be negative, but all of these skills, mindsets, and concepts that have increased your financial IQ and your overall understanding of how things work will multiply and help you grow further. So that's what I want to leave you guys with. That's all for this video. I'll see you in the next one. Ciao.